Okay, I'd like to open the Audit Committee meeting for the month of April. Is there any public comments?
Nope.
Okay, I need a motion to approve the minutes. All in favor?
I think your microphone wire came out.
You can use mine. Use mine. You use mine.
Okay, need an approval of the February 11th meeting minutes. Can I get a motion? Second. All in favor? Carried. Audit Committee work plan. The work plan is going to continue to be a part of our agenda. There is no Audit Committee meeting for the month of May. The next Audit Committee meeting is scheduled for June 27th. And the agenda items that will be included there are management letters, first quarter consolidated, green bus, pension plan audit, investment compliance report, and single audit and review. Mike, there is a change.
Yes, we have two changes to the work plan. One being the update on MTA Business Service Center. You heard it at the Finance Committee today, and if the committee wants to hear it again today, Charlie Mannheim is here prepared to speak to it. And the second is a request for additional audit services from Metro North regarding the agreement with Connecticut DOT, and management is here to discuss that with you as well.
Okay, any questions on either one of those items? I think all of us heard Charlie at the Finance Committee meeting. I don't think we need to hear him again. Does anyone? Okay, great. And request for additional audit services. Anybody have any questions on that?
Steve might come up. Steve? Do you need a vote?
Steve, why don't you just give us a brief rundown on what's going on with Connecticut and...
Sure.
Okay.
The Amended and Restated Service Agreement, or ARSA, is an agreement among the Connecticut Department of Transportation, or CDOT, the MTA, and Metro North. The ARSA provides for a fair and reasonable allocation of revenues and costs between Metro North and CDOT for the New Haven Line train service, which operates between Grand Central Terminal and New Haven, Connecticut, including the operation of 3 branch lines in the state of Connecticut. Metro North renders a bill to CDOT for the New Haven Line deficit. In 2010, the budget for this bill was about $88 million. Both Metro North and CDOT have agreed to an audit of this billing by Deloitte. The audit fee of up to $100,000 would be shared per the ARSA at 65% CDOT, 35% Metro North. Therefore, if the actual audit fee were $100,000, CDOT would pay $65,000 and Metro North would pay $35,000 for the audit. Both Metro North and CDOT agree that this audit is very necessary to provide assurance as to the accuracy of the bill and to be sure that all of the cost-sharing arrangements in the ARSA are properly reflected in the final bill to CDOT. In the past, billing disputes have occurred, which can take years to resolve. Recently, Metro North and CDOT came to a major settlement of prior year billing disputes, and Metro North and CDOT agreed that an audit was necessary to mitigate future billing disputes. This audit would be another set of eyes to assure the accuracy of the bill, and any findings in the audit would be incorporated in the final bill to CDOT. At the conclusion of the audit, an audit report will be issued stating whether the deficit billings are in accordance with the ARSA and its amendments. The audit report shall also identify recommendations to management and any significant internal control weaknesses in the billing process. We are asking approval from the Audit Committee for this audit of the ARSA to begin.
Hasn't this been done in the past? Why is this something unique and new rather than what has continued to be the relationship between Connecticut and MTA historically?
Yeah. This audit has not been done in the past from an external audit firm like Deloitte.
Doesn't Deloitte do all of the auditing?
Deloitte does the external audit of our financial statements, taken as a whole. What this does is take a the Metro-North financial statements and allocate a portion of those costs to Connecticut.
Yeah, but why wouldn't that be done historically? This is not a new arrangement with Connecticut.
It is not a new arrangement, but it's also not a focus of the external audit by Deloitte. Deloitte is focusing on our financial statements taken as a whole. What we're doing here is allocating a piece of the Metro-North revenue and expenses to the New Haven line, and it is a complicated arrangement of trying to split the costs between New York State and Connecticut.
I'm at a loss to understand why this hasn't been done historically.
In the past, Connecticut has sent people down to take a look at the bill to see if it's accurate, but both Metro-North and CDOT agree that has not been enough, and both representatives from both areas agree that this audit is needed to provide assurance for both parties to be comfortable with this bill.
I think also over the last year we've had more of a give and take with Connecticut. There's been a change in the politics there, and I think that we're getting to a point where I understand we've resolved a number of things that have been on the table for almost 10 years.
That's correct.
So that I think that we're trying to get this thing off on a right foot after all that change is the right thing to do. And I think that the apportionment on the bill is approximately what we expect that the cost sharing is 65-35.
Right. Yes.
In talking about the fact that we've settled past issues between us and Connecticut, do those past issues encompass the period of time through '09?
Yes, it encompasses the period 2000.
So this is the starting with the period that we didn't settle as
Correct.
a practical matter.
Correct.
Exactly.
That settlement was 2001 to 2009.
Are you seeing this as, I guess we're talking about 10 at this moment, but are you
Yes.
seeing this as a routine audit task that we would expect to build in going forward?
Yes. This is a fresh start for this year, and we expect that this audit will continue.
I mean, just out of curiosity, in terms of our overall audit, there's a standard of materiality, which I don't recall at this point, but I assume it's fairly large, $90 million. And this one, presumably, is there a comparable standard? It must be very small, or is there no such materiality margin at all? How is this done?
There's no materiality margin. If a correction of the bill is needed, a correction is made. That's how it normally works.
Yeah. Okay. I think that's the sort of the answer to your question about why isn't this covered in the regular audit? Because the regular audit is much more elastic.
Okay. Any other questions? I gotta move.
Do we know what the price of this is? Up to 100,000. Sorry.
Okay, I got a motion. Can I get a second? All in favor? Opposed?
What is the white bill by the hour?
Okay, that's the audit contract.
This is an extra task under the audit contract?
Yes.
Is that where we are?
Yes.
Yes, it
And
is.
whose rates we're negotiating. I can get you those rates. I don't know off the top of my head, but
Just curious.
yeah.
It's 100,000. Yeah. Okay. Carried. Thank you.
Thank you.
Okay, the next thing on the agenda is the 2010 financial statements. David and company.
Hello? My dime. Thank
Your
you.
dime.
I'm going to make the assumption, actually, this is a combination of the Deloitte audit team, or at least the partners serving the engagement, and all of the agency controllers. The reason is having everybody, to the extent that you have questions, we have people available here to answer them. As you know, we're in the process of performing our audit on the consolidated financial statements of the MTA and our audits of each of the financial statements of the various related entities that's disclosed in our letter to you dated April 13th. We will collectively refer to, while this letter applies to the MTA on a consolidated basis and each of its related entities on an individual basis, we will collectively refer to these as the MTA. As I said, we're in the process of completing our audit of the financial statements of the MTA. We expect to complete that audit probably today with your approval of the financial statements. We performed our audit in accordance with generally accepted auditing standards, which require us to do a number of things. One is to obtain an understanding of the system of internal accounting controls for the purposes of determining the nature and timing and the extent of testing that we perform on the elements of the financial statements, but not to audit the effectiveness necessarily of the system of internal accounting controls. And we're also required to report to you, as a result of these procedures, any material weaknesses that we would have encountered in the performance of our audit. I'm glad to conclude that we have no material weaknesses to report to you. We will have a management letter that will be presented to you at another date to talk about those other issues. We performed our audit in accordance consistently with the scope that we had previously discussed with you on our meeting of November the 15th of 2010. As we have in the past, we are required to review the financial statements for a number of reasons, mostly to determine that the financial statements present fairly in accordance with generally accepted accounting principles. As your auditors, we're also required to look at and review each of the material accounting estimates that appear within the financial statements. The purpose of our review of the accounting estimates is to determine if those accounting estimates are determined in accordance with generally accepted accounting principles and that their application is appropriate for organizations such as the MTA. The material accounting estimates that we've identified in our letter consist of the market valuation of investments and financial instruments, the allowances for uncollectible or doubtful accounts, depreciation, certain accruals and liabilities that appear in the financial statements that require a bit of judgment, other post-employment benefits, which is a material estimate that appears within the financial statements, the claims and judgments. We look at material and supplies, obsolescent reserves and inventory reserves, and the accruals of environmental accountings and contingencies and pension liabilities, and we look at the accounting and the estimates that are related to the derivative financial statements that appeared in your financial statements. We have determined that those financial statements that those estimates are in accordance with generally accepted accounting principles and that they are appropriate for use by the MTA in the preparation of its financial statements. As your external auditors, we're required to disclose to you if there were no uncorrected misstatement, or that there were any uncorrected misstatements of the financial statements. I'm pleased to disclose that we have no unrecorded accounting or audit adjustments that we found during our audit. There was one item that we considered to be a material correction of the financial statements that was booked by Staten Island by Sertoa on its financial statements that related to its OPEB expense. And what we found was that there was an overaccrual. So the amount that they had accrued actually exceeded the amount that was estimated by your actuary, so there was a reduction in that expense. As your external auditors, we're also required to review the significant accounting policies that appear in the financial statements, and those policies are set forth in Note 2 to the financial statements. The purpose of our review was similar to our review of accounting estimates, is to determine that the accounting policies are in accordance with generally accepted accounting principles and that their use is appropriate for entities similar to, or for the MTA. We have reviewed those policies and determined that they are both in accordance with generally accepted accounting principles and their use is appropriate. There were a couple of new accounting pronouncements that were implemented during the year, or that were certainly reviewed and became effective. One was the accounting for intangible assets that would have required the MTA to book certain intangible assets in their financial statements to the extent that they were material. We have looked at that issue. This basically relates to patents or trademarks or computer software. And for the most part, the intangibles that the Port Authority do, or that the MTA has, relates to software. Those items have been accrued in the financial statements, continue to be accrued, and therefore there was no real accounting change. From time to time, there are some intangibles that do appear that become known, but they aren't always readily determinable. Air rights, for example, occasionally shows up, and at the point in time that it's determined to be a viable intangible asset, those amounts are booked. Software that's internally developed is expensed. Software that's acquired that has a life of more than a year is deferred and amortized like a fixed asset over its, quote, useful life. Now, that's generally a short-term life for accounting software as compared to a building, but that's the policy, and that's consistent with generally accepted accounting principles. There was the accounting for derivative financial statements that we discussed with you in our review of the financial statements, particularly during the first quarter. We continue to look at that. The MTA does follow GASB 53, does use hedge accounting, and as a result, there are certain assets, liabilities, and deferrals that appear within the financial statements, the details of which are discussed in our letter. We had no disagreements with management. Management has informed us that there were no consultations with other accountants, and I can report to you that there were no significant issues discussed with us prior to our retention, and I can discuss to you that we are independent as it relates to our activities with regards to the MTA. We and management would be glad to, and by the way, we encounter no difficulties in the performance of our audit. Management and we would be glad to answer any questions that you may have. I will also disclose to you that drafts of the management letters, the representation letters that we will ask management to sign today are included as an appendix to the letter.
Okay. Any questions for our auditors?
Yeah, in going through your statements, you identify a large number of lawsuits that are outstanding in one form or another. A, I wondered the value of them. B, whether or not they're reserved in any manner, shape, or form. And C, how many are there? And
Well, the answer is, of course, I think councils are here with you, but I'll generally walk through the policy. There is an extensive bit of due diligence that goes on relative to determining the amounts that should be included in the financial statements for claims and judgments, we'll broadly call it. To the extent...
Excuse me, I assume we're self-insured on all of these claims. Is that a correct assumption?
No, not really. I mean, it's a little complex, and
I guess we can have somebody discuss it. But I'll tell you how generally the liabilities are accrued in the financial statements. There's a process that counsels from the various agencies are involved, and they identify items of litigation. And based upon their due diligence, which may involve outside counsel, discussions, their knowledge of the cases, they determine if it's what the status of the litigation is and whether or not what the probability of losing that is. If management determines that it is probable that there will be a loss, then they go through a process of estimating the potential liability, and they establish that, and they book a reserve for it. If it's possible, they may book a reserve for it. What they would determine is a possible loss. They may book a reserve for it, or they may not. Nonetheless, they'll disclose it. And then, obviously, there's a bunch of them that are classified as remote. So it's an ongoing process. That reserve builds over time. It is, by the way, and it is reviewed, I can tell you, it's reviewed every quarter, and it's reviewed every time the MTA has an offering. Because we go through that process.
To give you an idea, we have two types of reserves on the books of the Transit Authority. One is for injuries to third parties, and that's $422 million. The other one is workers' comp, and that's $720 million. So that both of them are computed actuarially. We take the reserves set by our lawyers, and we apply a series of factors to them that go back historically and trace how these things have
gone. And that assumes we're pretty much self-insured on the majority.
On a lot of the stuff, yes.
It's actually, there's some that you're insured for. There's some of it is dealt with by FEMTAC, and FEMTAC may have some self-retained reserves. They may purchase insurance on the second, on the market to cover some of these things. So it is not a process to say yes we are or aren't, but we do look at that. That's a part of establishing the liability. And obviously where you have insurance, where you have a third-party insurer, that's taken into consideration and established the amounts of liability.
The policy with FEMTAC has a very high deductible. It's about $8 million in the case of the Transit Authority. We used to do it with what was called the emergency. Marty, do you remember the ELF?
Right.
And there we had two claims that actually went and got money from the ELF. One of them was the 14th Street crash, and the other was Clark Street fire. And aside from that, I don't think we've had a claim against the insurance policy or against the ELF other than those. Okay.
Thank you.
But that's a very simple explanation for a very complex process.
Any other questions?
Pardon? What's the pension assumption rate of return, and has it been adjusted in recent years?
7.5%.
No. It's actually 8.
8.
Bob, do you want to?
Yeah, the pension, it was 8. We have received word that the state controller on our NISLR's plan is taking it down to 7.5%, anticipating that our actuary may determine that, or I shouldn't say our trustees may determine that we need to adjust the rate, or that NISLR's may adjust the rate. We built into our financial plan a higher expense, assuming a lower rate. So effectively, we are reserving in our financial plan for a reduction in the rate, but we haven't seen it yet except for NISLR's.
It's not significant. You're saying from 8 to 7.5.
Yeah.
In the real world, that's not much of a reduction.
There's not much of a reduction, but it's significant in terms of the extra cost to us. I think in total we're talking about $400 million in out years. So.
Any other questions? I know I found it interesting just to read through about the first 30, 35 pages. It really gives the story that we've been hearing about and reading about and discussing all year. The other thing I looked at was the last couple pages where we compare the financial plan And
Right.
boy, they're very, very close, and that's really says a lot for our people that our auditors have come as close to this. The other thing is, for Kevin, on page 13, I see that there's been an increase large increase in the post-employment benefits other than pension.
There's good news there, Jim, and bad news, as always happens. In 2008, we implemented GASB 45. GASB 45 requires us to put forward an actuarial, or book an actuarial contribution. The MTA chose not to fund those contributions. The only funding that's going in is the pay-as-you-go type of things, the premiums that we're paying now. So every year you're getting a slug of about $1 million net contribution, net of interest, and net of the payments that we make. And that'll continue to rise by about $1 million. The back sheet in this shows the initial unfunded liability for the Transit Authority is about $10 billion.
Okay.
Okay.
Any other questions? Can I get a motion to accept the audit as presented? Get a second? All in favor? Any opposed? Carried.
Thank you.
Thank you. And let's see. I would imagine. Hey, Dave,
David, does have a question?
when will it be ready formally?
Today.
To send them.
And
I think we're ready to issue it, assuming, have we received all the rep letters, Jill? No? We're waiting, assuming we received signed copies of the rep letters, we're ready to go.
And then we can put it on the website. Okay. Okay, there will be no audit committee meeting in May. Next one will be in June. The general counsel for Meet Changes will review the committee, their litigation and claims representations made to the public. So we're asked to go into executive session.
Before we have executive session, let me, it's been brought to my attention that there is a possibility that our quarterly statements will be late. There is a possibility that our quarterly statements will be late. And so we will work hard so that they're not. But there just seem to be some things through the Business Service Center working together that are slowing it down. So I think as Charlie's talked, we're going through kind of the, work it out process. But we don't know that it will, but I just want to give you a heads up that there is that possibility. I would assume it'd be 1 month if we missed it. Yes. Right. Yeah, that's right. So, good. Thank you.